So we're going to work on the income statement here, and this is going to require you to remember the income statement and what goes in it. So let's have a look here. The sales you figured in the sales budget, so let's point to that. Here's the sales for the year. Now, cost of goods sold. We don't have a tab for that. We had a tab for purchasing the goods that we're going to sell. But the cost of goods purchased is not the same as cost of goods sold. Cost of goods purchased is what you bought, but cost of goods sold is what you sold. So here we want units sold times the cost per unit. So cost of goods sold is units sold times cost per unit. All right, let's go find those. Plus, we're not typing in, we're pointing at the assumptions so that our budget is linked into a live model. Okay, units sold for the year. Well, we'll have to add all of them up, won't we? Actually, we can go, let's get it from the sales budget. We could add those four up and you could still do that. But I think I'll go and get the total units sold, not times the sales price, but what it cost us. So units sold times cost per unit. Sales price is what the customer pays. Cost is what we had to pay to get them. All right, and that was $7. So we sold them at 21, but we paid 7. And so the difference is our gross profit. Sales minus cost of goods sold is your gross profit. Now, sales commission, we can pick that up back on our disbursements for the year. Packing costs, miscellaneous expenses. Whoops, did I not do the budget on that? I didn't do the plus. Okay, that's what happens when you don't do the plus. And then right now there's no salary, but should you add salary in a scenario, we would be looking to that cell, should you put one in. Interest expense, we only had that in the 1 month, at least in my scenario, because I repaid the debt. If you didn't repay the debt, you would get all the interest in whatever quarters that it occurred. So income before tax is gross profit minus all the expenses. And you can do a subtotal for expenses if you want, or you can just create that the way you want to, the way I did here. After that would be income taxes. In order to do income taxes, they would have to give us an income tax rate, 30% or 20%, and then this times the tax rate, and then it would come down to net income. But here, we don't know the tax rate of these two individuals. It's not a corporation, and so we wouldn't use corporate tax rates and have income before tax and taxes and then net income. So individual tax rates depend on these two individuals, whether they have part-time jobs or whether they get part-time jobs, whether they have income from other sources. So their personal income tax rate might not even be identical. One might have a different one from the other. So here we're just going to ignore taxes and work on a pre-tax basis. All right, so when you come back, we'll do the balance sheet.